So investors, it's been a long week. It seemed to be more of a rinse and repeat, so I'm going to do a bit of a recap. I'm going to cover equities, bonds, inflation, geopolitics, and the ongoing AI transition with a focus on what's mattering for your portfolio. The bottom line, the S&P 500 peaked early November of last year and has gone nowhere ever since. Markets have been pausing and consolidating, not breaking. But the inflation pressure our team saw to start the year is building. Oil and energy markets have been the recent reason. So let's start with last week. March 6th through 13th was broadly down the third week in a row. The S&P 500 was down a little over 1.5%. Dow Jones down a little over 2.25%. The NASDAQ Composite down around 1.25%. So year to date, for the year, the S&P 500 is down about 2.5%. The Dow down about 3%. The NASDAQ down about 4%. That's not great, but it's not horrible given the rising uncertainty of slowing growth and higher inflation. So what does this sloppy action for the last 5 months tell us? It says to me, digestion so far, not a downtrend. It's pretty normal behavior after a V-bottom like April 2025, but it's not enjoyable at all. We've been and remain in a sideways rotational market for almost 6 months now. So what drove last week? Well, first off, inflation data came in higher than most expected, and that's before the Iran conflict that pushed rate cut expectations farther out. Second, oil prices surged, driven by an escalating tensions in the Middle East that have extended beyond Iran. Third, the rotation in the markets continued with money moving out of mega cap growth and into energy, healthcare, and some income stocks. So the takeaway so far is this is classic mid-cycle consolidation. Call it the 6th or 7th inning stretch, not a sell-off, not a reset, just sideways so far. Bonds and fixed income. Unfortunately, as it's been most of 2026, the bond market continues to send a very clear message. Rates are likely to stay higher for longer because inflation is higher than most want. What we saw last week in fixed income was treasury yields remaining elevated because inflation component, not the growth component, came in hot. Volatility in rates increased a lot into the weekend, and markets pushed out the timing of Federal Reserve rate cuts. Why does this matter to investors? It matters because higher yields create competition for equities. They also tighten financial conditions. Both stocks and bonds don't like higher trending inflation. As we've had for most 2026, I'm going to connect inflation and growth. So currently inflation is sticky and growth has been slowing in the first quarter, but investors, it's still positive growth. What's driving inflation concerns much higher the last 2 weeks is energy input costs reaccelerating, creating the risk that if oil stays elevated, the move in inflation is beyond its normal seasonal uptick, and we move from slowing inflation to reinflation. That would be very bad. On the growth side, consumer spending is holding up reasonably well at the high end, but it's not great in the middle incomes, and it's deteriorating quickly in lower income levels, while labor markets are slowing as well. So far, there are signs of a slowdown, but not a sharp downturn. For now, it's a softening environment that is becoming more fragile, with the Iran conflict being a huge swing factor. The Iran and broader Middle East situation is now directly impacting markets, with increased attacks beyond Iran's borders, affecting global energy infrastructure, and rising tension across the region, having driven oil prices over $100 per barrel and hurting fertilizer pricing and other input costs. Investors, the financial markets care about this now because this is pushing up inflation pressure in real time. How? By higher oil leads to higher transportation costs, higher goods pricing, and rising inflation expectations. Investors, so far most markets have been resilient because the assumption is that this conflict is contained and it doesn't escalate globally. But the risk is rising that if this expands, the consequences are inflation moves higher, the Federal Reserve stays restrictive longer, and that would put equities in the place of lower PEs as they contract usually in this dynamic. Let's shift away from geopolitics to something I'm more comfortable talking about and analyzing, and that's more long-term secular drivers in our economy like AI, artificial intelligence. The markets are moving from AI enthusiasm for everything to AI accountability. The markets now are asking, so where are the earnings? Where's the earnings growth? And where's the productivity gains? What companies are going to be benefits? What companies are going to see detriments to their companies? And what companies are capturing value, and who has a better or worse marginal return on invested capital. The Oak Harvest team is seeing continued heavy investment in AI infrastructure. We see strong demand for compute and power and early signs of productivity impact on some of our investments. AI remains a multi-year structural theme, but right now, expectations are being tempered. For now, what matters most? Oil prices and their effect on inflation trajectory, the Federal Reserve policy timing, and second and third quarter earnings and revenue expectations being achievable. For now, investors should stay balanced but maintain growth exposure, as it's one of the few asset classes that historically can out-earn and out-return inflation. For now, it's not a fragile market, but it is a sensitive market, and the sensitive markets react quickly to new information. Bottom line, markets are consolidating, inflation is the constraint. Geopolitics have been the swing factor, AI is a long-term driver. Oak Harvest guidance remains consistent. Stay disciplined, stay diversified, stay focused on your long-term objectives. We'll continue monitoring these risks and more and positioning accordingly. Investors, whether your priority is growth, income, or a combination of both, our Oak Harvest team is here to help you and your family plan for your financial future, whether you're in your retirement or nearing your retirement years.